Japan's central bank just held rates steady, but the message between the lines pointed clearly toward more tightening ahead. The Bank of Japan kept its benchmark interest rate at 1% at its latest policy meeting. The decision itself was widely expected. Markets had already priced in a pause after a series of rate increases in recent years. What drew more attention was the tone. Policymakers signaled that conditions for further rate hikes could develop if inflation keeps running at or above their targets. That shift in tone matters, and not just for Japan. For much of the last decade, the Bank of Japan was fighting deflation, falling prices, stagnant growth. The bank responded with ultra-low and even negative interest rates for years, an era of extraordinarily cheap money. The gradual move toward higher borrowing costs represents a genuine turning point for one of the world's largest economies, and it has global implications. Japan is one of the largest holders of foreign assets, including US Treasury bonds. When Japanese interest rates rise, the calculus changes for Japanese investors. Domestic assets become more attractive. Some of that money can flow back home. And when it does, it can ripple through global bond markets and currency markets alike. Inflation in Japan has stayed above the Bank of Japan's 2% target for an extended period. Wage growth in parts of the economy has added to that picture. Together, those developments have given policymakers more confidence that the long battle against deflation may finally be turning. Holding rates too low for too long, they now believe, carries its own risks. The Japanese yen tends to strengthen when the Bank of Japan signals a tighter policy path. Higher domestic rates make yen-denominated assets more attractive to outside investors. A stronger yen, though, creates a different pressure. It weighs on the earnings of Japan's large export companies, since their overseas revenues are worth less when converted back into a stronger currency. Equity investors and currency traders watch these signals closely for exactly that reason. The timing of the next rate move remains uncertain. The Bank of Japan will be watching wage growth and domestic consumer spending closely. Global headwinds matter too. Trade uncertainty and slower growth in key export markets could complicate Japan's recovery and give policymakers reason to move more carefully. The next Bank of Japan policy meeting, along with fresh data on Japanese inflation and wages, will be the clearest indicators of when and how quickly the bank moves next. The practical takeaway: if you hold assets sensitive to US Treasury yields or the dollar-yen exchange rate, the Bank of Japan's policy path deserves a place on your radar, even if the next move is still months away. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.